Most people think of buying an investment is the same as buying their own home. But trust me, it's not. You see, at the end of the day, you're not buying the property so you can get a tax deduction and house a tenant. You should be doing this so you can set yourself up for a comfortable retirement. So what I find when buying an investment property in whatever suburb, it's always to buy that investment in. Now you too can use this as a guide when buying an investment. Is there a difference between buying your own home that you're going to live in to buying an investment property? Absolutely. And let me tell you, if you don't understand this difference, you could be making a massive financial mistake. Most people think of buying an investment is the same as buying their own home. But trust me, it's not. And today, I'm going to show you exactly why. Welcome to EST. We're here to help you build real wealth and secure your financial future. So if you're serious about growing your wealth, make sure to subscribe, like the video, and drop a comment below. Success is built on knowledge, and we're giving it to you right here, right now. So if you're buying a property, let me guess, you go to the bank to buy an investment property and you ask them, what's my borrowing capacity? They punch in the numbers and they say, congratulations, you can borrow $850,000 to buy an investment property. So what do? I bet you go straight to realestate.com or domain and type in maximum price 850 and start looking for the prettiest property you can find. You inspect it, you like it, and you buy it. Sound familiar? Here's the problem. You didn't actually think whether this is a good investment. You just bought what the bank said you can afford. And that, my friends, is not how to build wealth in real estate. Look, whether you're at one of my seminars, a business event, or even a family barbecue, I always get asked the same question. John, how do I buy a good investment property? I look at them straight in the eyes and I say, that's simple. Ask me. And they say, we did. And I said, no, Ask Me is an acronym, ASKME. Now you too can use this as a guide when buying an investment. So what does Ask Me stand for? Well, A is for acquire right. You see, you have to acquire right. And there's a saying in real estate that you make your money not so much when you buy the investment, but when you sell it. Yeah, sure, you realize the gains when you sell it, but you really make the money when you buy it. That means buying in the right area or the right suburb. Most people think investment property is just bricks and mortar. But to me, as an investor, it's more about the area or the suburb that you're buying it in. And that's extremely important. Now think of this analogy. Think of this beautiful serene pond. On that pond is a duck. So the pond is the suburb or the area, and the duck is the actual property of the building itself. Now, if you've done the right research and you've selected the right pond, if that pond is fed through different estuaries and streams and creeks, what happens to the level of that pond? It begins to rise. Now, as a consequence of that happening, what happens to the duck? Well, the duck also rises. It goes up with the water level, doesn't it? So in our case, the investment property increases in value as well because it's acquired in the right suburb. And that's extremely important. The next letter is S. S stands for structure. Structuring your investment is so important, but there are two main areas that you need to focus on with the structure. One is the finance structure, and the second one is the tax structure, or more correctly, the tax efficiency of the property. Is it wise for you to take out a principal and interest loan or an interest-only loan when you're buying an investment property? Well, there are two main reasons to take out an interest-only loan. The first is because you only pay back the interest, and that's the part that comes out of your pocket as far as the cash flow, which is it's much less and it leaves a lot more in your pocket. Secondly, the Australian tax office does not allow you, the investor, to claim any principal component of the loan. So you don't get any tax deduction for paying back the principal. So why pay back the principal, receive no tax deduction, when you can use that money to pay down your non-deductible home loan and get it off your chest much quicker? So that's the finance. Now, let's look at the tax effectiveness of the investment. When you have an investment, you get to claim all the expenses incurred in running that particular property. There are two main types of expenses. There's the cash and non-cash. Let me explain. Cash. Cash expenses are expenses that you physically have to pay out of your pocket from your bank account. These are things like interest to the banks, letting fees, insurances, management fees, rates, and so on and so forth. So whatever you've paid throughout the financial year, you can actually claim that or deduct that against any income you've earned that year from your job. I mean, that's straightforward, right? Okay. The second deduction is non-cash, or as some accountants like to call it, paper cost. This is depreciation. And there are two main types of depreciation. There's building depreciation, and the second one is fixtures and fittings. Fixtures and fittings are things like floor coverings, hot water system, carpets, and so on and so forth. You see, over time, they're going to eventually wear away and they're going to be replaced. So some obviously quicker than others. Now, the building component or the construction cost. Well, that can be written off at 2.5%, 40 years. 2.5 times 40, 100% is written off. The second one is your fixtures and fittings. There are two methods that you can use to write these down. There's the diminishing value or the prime cost method. I don't want to get too technical with you at this stage, but if you've got any questions about which ones to use, either talk to your accountant or send me an email and I'll explain it to you. But really, all it means is that the more you can claim through depreciation, the less that you have to pay out of your own pocket, which is really, really important at the end of the day. The next letter is K. K stands for keep it. You see, most people want to get into real estate and they just want to make a quick killing. And you can, but you can also lose a lot of money if you try to buy right and sell right and try to guess the market, where it's heading and so on. I call these people not so much property investors, but property speculators. Property really should be looked at as a long-term investment. You see, at the end of the day, you're not buying the property so you can get a tax deduction and house a tenant. You should be doing this so you can set yourself up for a comfortable retirement. That way, you can live off the rental incomes from your property portfolio when it's time for you to sort of wind back and slow down. Now, M stands for the management of your property. This too is really important. Why? Because you can sleep better at night knowing your property is looked after by professionals that do exactly what they say they're going to do. You know, there are a lot of companies out there, real estate agents and property managers that say, oh, we'll give you a report once every 3 months, yada, 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 BS. And that never really happens. My advice is to develop a good working relationship with your property manager. Do things like send them the odd gift card or gift basket for a job well done. Look after them, and I promise you, they will look after you. The better communication, the more regular communication, the more informed you become. You know, you learn about what's really happening with your property when you have a good relationship with your property manager. And the last is E for exit strategy. See, the thing is, you don't know what's going to happen down the track. One day, through no fault of your own, you may have to sell your investment really quickly. So what I find when buying an investment property in whatever suburb, it's always to buy that investment in the medium property price range. Medium means the middle, not the average property price. There's a big difference. Medium means that 50% of the properties in that suburb sold below that price and 50% sold above that price. This is where the greatest number of properties are sold. Now, that's important because if you want to exit your investment quickly, there are more people wanting to buy in the median property price than on either side. So let's recap. How do you invest? Ask me. ASKME. A stands for acquire right. S stands for infrastructure. K stands for keep it. M stands for management. E, having a good exit strategy. Just send me a comment or an email and I'll be happy to get back to you. So I hope that was helpful in helping you help yourself.